we're talking about companies that want to adopt ESG nomenclature, that want to comply with it, and also in terms of investors and the reliability of some of those designations. So I just wanted to start with, just to get started with what some of the biggest advances have been in the ESG designation and how companies comply with it. And Sharon, I want to start with you in terms of the biggest changes that you have seen over the past couple of years in how companies approach this.
Well, first, thank you so much for having me. It's been almost exactly 3 years to the date that I was here speaking about gender lens investing, when that was sort of a cliche. And it was a time when people were like, this ESG thing, that's just a fad, right? I was like, no, I think it's got legs. So the good news is it has long, long legs. And it really has evolved. I mean, it's something that companies care about, their employees care about, regulators care about it. You know, I think just it's evolved in a really good way.
And Lynn, how many companies have struggled to comply and turned to tools? I know that you're, for example, on the advisory board for dealing with trying to diversify some of the boards at times when companies come to you and say, we can't find people.
Yeah.
So how exactly do you go about that?
Yeah, so thank you again for having me today. I agree with your sentiment. That's wonderful to see so many people in person. The way we like to describe what we offer at the NYSE is we offer a variety of tools that help customers embark on their ESG journey. Their ESG journey, as you point out, Lisa, could be adding diverse candidates to their board, which we offer a service called the Board Advisory Council, which Sharon is one of the chairs of. Started in 2019, focused on about 30 of our listed company CEOs nominating diverse candidates that they can personally refer, personally vouch for into a database. Our database now has grown to about 300 different diverse candidates, sorted by what their expertise is. Are they a financial expert? Do they have nom and gov experience? Things of that nature. And that really allows our listed community to pull from a database of pre-approved, pre-vetted, diverse candidates that they can very easily add to their board in a variety of different disciplines. It's already resulted in 20 placements of the 300 people that we have in our database. But it really hasn't stopped there. We've continued to evolve our services. We just announced our Sustainability Council, which is going to be a new council for us. It's going to really help the emerging and increasingly important voice in the C-suite, which is the Chief Sustainability Officer, develop tools, practices, share information around their own disclosures, particularly with some of the regulations that are coming out, which we know is going to be important for the listed company community.
Okay, so let's start with some of the new regulations, since, as Sharon said, it's hot off the presses. You're hearing it here, not first, but very close to first. On Monday, we were talking about how the SEC released some of the designations and the guidelines for how they would like companies to report certain standards having to do mostly with the environment, I believe. What do you expect the response to be? It's now in a comment period. What do you expect the response to be from investors and, frankly, from companies?
I expect the response to be really robust, as it should be.
Which is code for.
Exactly. I mean, there is at least a 2-month comment period, and that's part of the process. I know as a former regulator, I always appreciated getting different viewpoints. And I think it makes for much better decision making. And so we look forward to engaging our listed companies. As you know, everyone's at different stages in the ESG journey. You know, there's no one size that fits all. And so we really look forward to engaging our listed companies, their customers, regulators, working with the commission, you know, as they work through that process.
Well, as is, Lynn, how standardized have some of the criteria become, especially if people want to feel like the E and the S and the G are actually the E and the S and the G?
Yeah, and that's been one of the big challenges, the standardization around reporting. But if you look at the proposed regulation that came out requiring Scope 1, Scope 2, Scope 3 emission disclosure, and we look at our community of listed companies, which we like to think we have the most thoughtful, best governed, most entrepreneurial companies, 81% of that large cap company group is already disclosing what was proposed in the rulemaking, meaning firms have already embarked on the journey of figuring out how to disclose scope 1, scope 2, scope 3 type greenhouse gas emissions. It was something that the largest, most well-governed, most thoughtful companies were already in the process of thinking about how to put into the electronic universe, mainly because the investor base over the last 2 years have been voting with their investment dollars and believing in those companies who are disclosing, who are giving transparency, and who are doing the right things in terms of the environmental, social, and governance pillars.
Sharon,
And I would just add to that, too. I mean, most of these companies are global companies, and regulators across the globe have asked for disclosure in many different ways. So that's another reason why many of our companies are already further along in that journey.
are these criteria, Sharon, encouraging or discouraging companies from going public?
Depends on who you ask that question, to be honest with you. I'm a big fan of transparency and giving investors the information that they deem to be material when they make an investment decision. At the same time, I want more companies to be listed. I'm a big believer in transparent markets because we know what happens when we have dark, opaque markets. As a former regulator going through, the Great Recession, it's not a good market when you can't see what's happening. And so transparency is not only just good for everyone, but it brings trust back into the marketplace and credibility. It makes our markets much more efficient. So,
Well, are you concerned about some of the less visible areas of the market, whether it's private equity or private investing, that are purposely trying not to comply with some of these aspects going forward, given that there's been so much money raised there?
I wouldn't say that they're intentionally trying to avoid the laws. I wouldn't characterize it. They're just not subject to them.
Right.
That's not to say that private equity companies aren't cognizant of the fact that investors care about these issues, and some of them, in fact, are providing board diversity and those types of things. So I don't see it as an either or. But I definitely want more.
And I would say many private equity companies are encouraging disclosures before a company goes public. Particularly their largest portfolio companies. I think what a private company needs to do from a disclosure standpoint, there's a machine that has to go behind that. So they have to get the machine ready. And a lot of the companies that we're talking about coming public in the near-term future are really excited to tell their ESG story. Many of them preemptively launch sustainability reports prior to becoming a public company now.
Lynn, we're at a tenuous moment for some of these categorizations with the Ukrainian war and what's been happening with suddenly this focus on domestic production of oil and gas in the United States, a shift away from Russian sources, and this feeling that perhaps there is a social purpose to supporting certain companies that people previously had been stepping away from. How quickly, how dynamic are some of these indexes? How much do you get questions about these types of issues?
Yeah, on the index side, on the ICE side of the business, we do get questions, and what we do is consistent with IOSCO principles, consistent with benchmark regulation principles. We go out and consult with our market participants. We follow a formal consultation process, and based on the results of that formal consultation process will tell us should we remove an entity from a set of indices or should we keep it in. We just recently announced that we were on the ICE side of the business removing Russian entities, both from our fixed income and our equity index platform, and that was following such a consultation. I know a lot of the other index providers follow similar processes. Very transparent process.
How dynamic is it, though? I mean, how frequently are those assessments done?
They're done pretty much any time there's news and pretty much any time there's a significant amount of market volatility, like we saw in March of 2020. We followed a robust consultation process in March of 2020 about what to do with rebalancing our indices, whether it was the right thing to do for the market or would it add stress to the market in March of 2020, and we opted not to for that reason on the fixed income side, because we thought it would just add too much stress based on the results we received. This process that we followed and all the other index providers followed was a very similar process. We saw the sanctions, we saw the actions taken by the exchanges, including the NYSE, who was the first exchange to halt Russian securities following the sanction imposition last weekend in February. And based on the results and based on what our peer group was doing, we made the decision that it was the right thing to do to remove those sanctioned entities, not just sanctioned entities, but Russian entities as quickly as possible.
Commissioner, when you take a look at the companies desiring to comply and trying to, yes, it's born out of this flood of money going into these designations, but what are the conversations like when you talk with them about how much their performance can improve, what it can actually do for their resilience or their bottom line?
So the good news is there's data out there. I mean, there was a point in time when there was a question as to whether, for example, diverse corporations or companies that had diverse boards, whether they perform better. The good news is the data's there, lots of studies that kind of show that. In addition, I think companies understand that they've got different stakeholders that they have to address. So it's not just the investing public, although that's obviously the most important one in many respects, but it's also the people who walk in every day, the employees, it's the communities where they work every day. And so the idea of being a good corporate citizen, I think, is embedded in a number of companies. And I think, particularly the last 2 years, the ESG, the SG part of it, companies are responding to things. How can we make our universe a better place?
What's the data point that you like to look at to talk with companies to really explain the bottom line benefit other than just, it feels right?
Well, stock prices is one good indicator of, of a company's, the stock price tells you a lot about what the market is saying. I mean, that's the good news about, transparency is that you've got people who have opinions about whether this is a good thing or a bad thing, and will make their investment decisions, accordingly. That's not to say that, markets go up and they go down. And they do so, often for a reason, because of uncertainty in the marketplace. But I do look at the markets. I mean, not just because I chair the board of the New York Stock Exchange.
Because of your role.
Yeah, not just because of that. But it does, whether it's inflation rate environments or the news of the day or war of the day, that uncertainty creates volatility in our markets, which is why, I'm proud of the fact that we've got the technology and the human judgment to make our markets a lot more resilient and a lot more transparent.
What kind of performance differentials do you point to on an index level? Because I know that that's something a lot of people have looked at when the market has grown. I was looking at some statistics, and at the end of 2018, for example, things have surged. I mean, it was insane, right? It was like a 42% increase in 1 year from 2018 to 2019.
So one of the many interesting fact points I like to use is during the pandemic when there was a ton of volatility in the market, you saw about 30% outflows out of your standard equity funds. You saw 5% inflows into ESG-driven funds in the height of volatility, in the height of the pandemic. To me, the silver lining of the pandemic was it really put a finer point on the returns that can be driven by portfolios that include ESG risk metrics.
So, Lynn, when it comes to index construction, what's been your biggest concern about how things are working in terms of either consistency or the greenwashing or whatever people take a look at and have sort of tried to poke holes in because that's what they do?
I guess one of the challenges with indices is to really how to build your constituent universe and what to use on the ESG side as either filtering criteria or as weighting criteria. Filtering criteria is a determination of what actually goes into the index versus what doesn't go into the index. Weighting criteria is a bit more subjective. It tends to be how much a particular stock in an oversimplification receives as a weight within the index, if it's something that's more environmentally focused or more governance focused. On the latter, that tends to be more subjective because there are a variety of scores in the market, and there's still a lot of discrepancy when you look at the various scores that go into the market. So you really need to talk to a customer to really understand what type of exposure they're looking to achieve for and whether it's something that can be solved by more objective filtering criteria, which is more transparent what's put out in the universe, as opposed to something that's more weightings based.
And Commissioner, from your perspective when dealing with companies, I wonder how effective some of the measures have been. Where have you found problems in terms of either retention of women and people of color in prominent seats, or whether it's, compliance with certain environmental criteria that are changing quickly? Are there any areas that you really find companies struggle with?
All of the above.
Okay.
Pretty much. We've got room for improvement. I mean, we've made progress. Don't get me wrong, we've made tremendous progress, and we're all moving in the right direction. And I'm a problem solver, and so as Lynn mentioned, one of the reasons we created the Board Advisory Council was to create a database so people couldn't say, well, we can't find women, we can't find qualified minorities to serve on boards. And so knowing that, for example, the referral process is how most board seats are found. It's like you ask someone, and they ask someone, and they ask someone. So we said, we've got the brand of the New York Stock Exchange, we've got the CEOs. Recommend someone that's board ready, someone you will vouch for that can sit on a board today. So that's one of the ways we decided to solve for an issue, was to provide our listed companies with a source and a resource.
Are there any other steps like that you foresee in the offing?
Of course.
Okay.
We're going to continue to make progress, obviously. And I think, as Lynn mentioned, in terms of ESG, we do need some sort of standardization because it's sort of an apples and oranges situation. And so I do look forward to working with companies to decide what those standards would look like.
And one thing, Lynn, this is sort of my wheelhouse, so I have to ask you about this. But I know that when you took over the ICE units and then the index business, that has a lot of a fixed income, and a lot of people are wondering how this all translates into fixed income disclosure, especially because a lot of these companies are not public. And how do you standardize it in the same kind of way? What kinds of progress has there been on that front?
Yeah, I would say that it depends on the asset class in fixed income. You think about an asset class like munis, for example. Not a lot of disclosure in the muni universe. Not a lot of disclosure full stop in the muni universe, be it financials or ESG type of information. We've attempted to layer on some of that with a service that we have, which looks at climate risk, specifically tying that to municipalities so they're not obliged to disclose. We're able to measure things like wildfire risk, things of that nature, down to an individual municipal security level. So it allows us to create indices in the fixed income side of the business without requiring a municipality, for example, to disclose. If you look at something like an investment grade index or a high yield index, a lot of times there is disclosed information because a lot of those companies are public entities. So those tend to be a little bit easier. And as more and more companies are embarking on their disclosure journeys, you'll see those types of indices get more refined. Those types of benchmarks that folks are looking to mark their portfolio against. That'll get more refined as disclosure improves.
More broadly, Lynn, when you talk about ESG indexes, how much is this catering in some ways to a younger investor group? Because I think about, the institutional investors have voting rights. They can affect change in other ways if they want to. Pensions can do it their way. How much is this really the millennial, if I want to use a cliche, and others?
Clearly, retail is playing an interesting role in that, but it very much is on the mind of the institutional user. We get asked about that as a public company all the time. I can't tell you the number of investor meetings that I'm in that are starting to go along the ESG type questions. For example, we're quite proud at ICE that following our next annual general meeting, we'll have 60% female directors. That's something that will come up in our investor meetings going forward.
I would add, out of that 6, 3 of us are women of color, which is a great thing.
And Commissioner, I wonder from your perspective, do you find that companies ever get frustrated that the E, the S, and the G are lumped together because they feel like they're each distinct issues that they try to address in very different ways?
I get frustrated that they're linked together, to be honest with you.
Because they are very different.
Because they are really
very different.
They're really different things.
But we're lumping it all together, and I feel like it just stays very superficial. And how much do you sort of dive in?
Well, again, for some companies, they're going to be more focused on the E, some on the S, and some on the G. I think for the most part, the governance is the easiest part for companies to be focused on. Societal sounds a little bit too wishy-washy for companies, and so For them, it's deciding like what's really important to the investor, what's really important to our employees, what would make a better customer, a better product. And so I think it's really evolving, if you will, and maybe ESG will become, I don't know, XYZ, next week, and you'll be some other nomenclature that's more indicative. And I do think, with data, it informs decision making. Before people would speculate as to the effects of things, I think data is something that people really can respond to when you can look at real numbers, if you can look at KPIs that make sense. And so I see it really kind of evolving, and so.
When you talk about the social and the fact that some people look at it and they're saying, it's wishy-washy, how much does this stem from this sort of, washing everything in a political brush rather than digging in and understanding what aspects of a company can actually make them perform better, make them have more resilience?
So I don't see S as being a political issue, to be honest with you. I mean, S is about the talent pool. Like, who would you like to hire? Wouldn't you want to hire the smartest people in the room? They're going to include women and people of color. Wouldn't you want to produce products that are safe for people? They're more likely to buy those products. And so I don't really kind of view these in political terms. It's more of what's best for our communities, what's best for our employees. How do we retain talent? And how do we make our markets much more efficient and visible to people?
Lynn, what do you think will be the biggest advancement on the index side going forward, given the fact that there is so much money flooding in? How big do you think they're going to get, and how will they be fine-tuned as we talk about XYZ instead of ESG?
I mean, I think the trend is there where you're seeing more and more money come into these types of investments. I'm hoping in 10 years from now, this is just a standard conversation as opposed to a discrete panel on ESG as just a standard type of philosophy that customers follow. So it's hard to say because you also see the dynamic of more and more money flooding into fixed income, to your point earlier. But there's still a tremendous amount of money flowing into equities as thematic equities continue to gain relevance. So,
Commissioner, before we wrap up, I would love your sense of what companies should know as they embark on that sort of soul-searching process of how to be more compliant and how to be a better company.
So I'm a big believer in sharing best practices, which is why I really believe in collaboration. And so I would tell companies that you're not alone in this journey. Like, no one has this perfectly. Some of you may be doing a better job than others, but we can learn from those companies that are doing better at some things but not others. And so again, I see that evolving along the continuum as people become a little bit more educated, as investors want more information, as data informs us as well. So I really do see this as a journey.
And anything to add?
yeah, I would just echo Sharon's comments around transparency and sharing information. One of the services that we run within ICE, which is very popular with our NYSE issuer community, is our ESG reference data database, which I like to characterize as a company's electronic ESG footprint. So what that does is it provides 400 different attributes roughly around environmental, social, and governance factors. But it's all quantitative based. It's what companies put in their sustainability reports. It's what they put on their websites about ESG. How many female directors, what's your average board tenure, things of that nature. What that allows a company to do is look at their peer group for who are the best performers. And they can see what that peer group is putting out. They can also see what some of their suppliers are putting out, which is going to help with their Scope 3 disclosures. So that's a great way for a company that is thinking about going public to get a crash course on what ESG disclosures really mean from folks who have evolved for hundreds of years as listed companies on the NYSE.
Well, I just want to thank you all, and especially you both for being with us. It was fantastic, and good luck.
Thank you for having us.
Thank you.
Thanks.
Thank you,
Take
guys.
care.